The ADL, or acquisition and development loan, will be repaid at the end of the estimated stabilization period. And so, some strategies to help reduce project risks and increase the chances of getting ADL approval are pre-lease the space to tenants before construction, take out a commitment. So that would be a permanent loan secured prior to construction. So a takeout commitment. A standby commitment for permanent financing from a standby lender would also reduce project risks. And then a pre-sale agreement with an investor or final owner prior to construction. So all of these strategies would help mitigate the risk to the real estate developer. And lowering risk would help with financing because it would make the project less risky and potentially allow the lender to justify a lower interest rate on the project. So now, fast forward to when the project is funded. And remember, we're funding construction. How is the money dispersed? Well, typically that happens with what we call the monthly draw method. So in this method, the developer requests a draw each month based on the work that's been completed during the preceding month. Another way to do it is that the developer would just submit invoices to the lender through a title insurance company and would just be paid based on those invoices. And then lastly, the interest rates on construction loans are generally going to be based on short-term interest rates because these tend to be shorter-term projects. That's why we think of that long-term financing as permanent. This is more temporary. So most lenders rely on a system of floating interest rates. So those would be more representative of short-term rates. So it could be based on the bank's prime lending rate, it could be based on T-bill rates, or it could be based on the London Interbank Offered Rate, or LIBOR. So just to illustrate how all of this works, we can walk through a project for a real estate development. So in this particular project, we've got a 12-month development period. So we'll be taking out a construction loan for 12 months. And the way the developer wants to handle the draw is that 75% would be drawn down in the first 4 months, and then the remaining 25% would be drawn down over the remaining 8 months. We've got a 6% interest rate and a 2% construction loan fee. And then we've already got the terms for the permanent financing. So on that, we've got a 25-year amortization on a 10-year loan at 5% with a loan fee of 3%. So we've got land and site improvements, and then construction cost, hard cost, and soft cost that give us our total project cost. So our construction loan request will be for the improvements, the hard construction cost, and the soft cost to give us a total amount to be financed. And then we have an estimated interest carry, and we will show you where that comes from. So this is just the total of the interest that's being rolled back into the loan. And so the interest carry plus those hard and soft costs give us the total loan amount. And there's an equity requirement on this loan. And when you add the equity requirement and the total loan cost, we get the total project cost. And so from that, we can take a look at the repayment schedule, which shows the cost, the interest, the draws, and the loan balance for each of the 12 months of the loan. Then remember, after that 12 months of construction, we have permanent financing planned at 5%. Remember, amortized over 25 years with a 10-year term. So we would just be financing on a permanent basis the amount, the construction hard and soft costs plus that interest carry. So based on our interest rate and term, we can calculate the debt service per month and then multiply it out by 12 to get a debt service per year. And because of that loan fee, we can calculate a yield to the lender, which will be slightly higher than that rate. Lastly, we can take a look at the pro forma statement of cash flows over the construction and operating periods, and these will show us where the equity is coming from and the breakdown of all of the costs involved.